Welcome, welcome. Turn your camera on if you can. Say hi.
Hi, John. How are you?
Hey, doing good. Hey, Gina. How's it
Gina.
going?
Good. How are you?
Doing good. Good to see everybody. A nice toasty night out there.
Yes, it is.
Yep. Good night to stay in for a Zoom meeting.
Yeah. Yeah, we'll get started in just a minute here or so. Yeah, good morning, guys. Good to see everybody. Welcome, welcome. We'll get started in just a minute. It's right at 7, so I guess we can go ahead and start. Lloyd, if you want to go ahead and get us going here.
Okay. Yeah, I want to welcome everybody. I'm Lloyd Allender, the president of the St. Louis Real Estate Investors Association. Welcome to our February 16th, our main event for February. Tonight we've got John Bowen of EquityTrust joining us. And I did want to make a little announcement. So remind folks, if they haven't joined us on our every Friday, we have a legal update at 11 o'clock. You can find a link to that on our website, stlreia.com, or on Meetup if you're one of our Meetup members. The link to that. Always get some informative information from the attorneys at Davis and Travaglini on the status of the court system here in the St. Louis area. And then coming up in March, we also, John Bowen is going to be back with us on March 13th at 9 a.m. on a Saturday for the master class in self-directed IRAs and 401ks. So that's what we got going here in the near future. And John's always got more things cooking in his stew pot for future meetings. So stay tuned. Anyway, I won't keep Mr. Bowen waiting. We got John Bowen. He is the national speaker for the Equity Trust Company. He's trained over 50,000 real estate investors and entrepreneurs in his. He's going into his 12th year with Equity Trust, and we're glad to have him with us tonight. And he is the man in the know on self-directed IRAs and 401ks. So I'll leave it to you, John. Thank you.
All right, outstanding. Hey, appreciate it so much. Really excited to be here this evening. Generally, I have the opportunity to come out and actually visit face-to-face with this group. So this is a first time for me joining you from afar here from Cleveland, Ohio. But needless to say, we have troubling weather on our side of the country as well. Well, I guess we're not too far away, maybe about 8 hours or so. So it's good that we're all able to be here safe in the comfort of our own homes, or as I'm here in our what we call virtual classroom here at Equity Trust Company. Given the conditions of the pandemic, we aren't able to host live events like we have done all throughout the country. So we are now in the comfort of everybody's homes across the country. So I'm really excited to be here. This is our virtual classroom where we teach investors all throughout the country how to create wealth and preserve wealth, utilizing self-directed IRAs, 401ks, and various other types of retirement plans. The agenda that I have prepared for you tonight is an agenda that will include talking about, of course, a self-directed traditional IRA, self-directed Roth IRA, but I also want to spend a little bit of time talking about the self-directed 401k, because as a real estate entrepreneur, as a business owner, you potentially have the opportunity to utilize a unique type of self-directed account that you may not have known about, or maybe you know about a self-directed solo 401k, but you haven't really ventured into all of the details of the power of the account, the capability of the account, and most importantly, whether you are eligible or qualified or not to utilize one of these particular types of programs. Now, as a starter, hopefully folks are taking diligent notes throughout the program. As a starter, I'll mention that I'm not necessarily here this evening to just share with you, this is what a self-directed IRA is, this is what a self-directed IRA isn't, here's the tax nature of the account, here's how to make contributions. I would venture to assume, and from talking with John and Lloyd, my understanding is this group has already had some pretty significant exposure to self-directed IRAs and what they are. And so my goal tonight is to share with you real world application, how real clients across the country are investing in real estate with their self-directed IRAs, the strategies and techniques that are working in today's marketplace. Now, how I do that and how I've done this for many years is I'm an active real estate investor myself. And when I say active, I should say I'm a part-time real estate investor. I own properties, I do private lending, and then I also spend my time teaching and training here at Equity Trust Company investors all throughout the country. And so I have the privilege and the unique capability to be able to gain access to all of this information and all of these clients across the country, and they share all these incredible deals with me. And so then I can take these deals and compile them into an educational course like this and provide that information to you. And like John and Lloyd had mentioned, we do have a Saturday workshop coming up on March 13th. And certainly we will share the link with you at the conclusion of today's program. So if you like what you're hearing tonight and you want a little bit more, we'll have another opportunity for you to explore that. So tonight is very much going to be focused on real client applications. I'll share with you some of my deals and some of the things that I'm looking at. And also I'm excited to share with you an investment strategy that is becoming what I consider to be one of the most powerful real estate wealth creation tools in self-directed IRAs. And that's a real estate joint venture concept. And so I'm going to share with you a real deal that just concluded, just closed. An investor out of Milwaukee, Wisconsin. His name is Scott. He partnered up with another investor in his local real estate investor association. He invested $24,000 with his self-directed Roth IRA in a fix and flip deal, and he made $42,000 tax-free in his Roth IRA. And so we're going to talk about those types of transactions throughout today's program. So even if you're somebody that maybe only has a little bit of money in an IRA to start with, you know, let's say $5,000, $10,000, $15,000, I think that you'll learn upon the conclusion of tonight's program that there are capabilities and there are mechanisms by which you can grow a small dollar IRA like that. So with that being said, let me pause there for a moment. I want to make sure that I'm committing myself this evening to you guys and specifically what you guys want to accomplish. So if I could just pause for a moment, and then in the chat box, if you could put in there why you came to tonight's program. I understand that you saw on the itinerary that we'd be talking about self-directed IRAs and self-directed solo 401ks. So if as many people as possible could just put in the chat box for me, what is it that you were looking to get out of tonight's program? Maybe it's one individual question you have. Maybe it's something more broad, but let me give everybody a minute here to put in the chat box, what is it that they were looking to get out of today's program? I'm asking you this because I want to make sure that I address the specific needs and desires of this group. And if there's something that I don't answer for you this evening, I will circle back to make sure we get that answered for you. Or maybe it's something that we'll answer in the March 13th extended workshop, which you can take advantage of as well. So we got questions coming in on how to start it. Tax advantages, that's a great one. You'll learn that these self-directed IRAs and 401ks have unique tax advantages associated with them, which can be very powerful from a what I call compounding interest in the absence of taxation perspective. All right, want to learn more about tax advantages, seeing a lot of, and this is very frequent around tax time, trying to determine ways that we can mitigate our tax liability, all things that we will address in today's program. All right, strategies for LLCs, learning about filling out 1099-Rs, self-directed solo 401ks, about paying myself. Okay, great. So certainly a lot of what I'm seeing here, I already have planned in my agenda. And then the items that I have not, I'll make sure to incorporate Keep that coming. If you do have questions, feel free to put them in the chat box, and I will do my best in my peripheral to answer those as we move throughout the program. This program is for you guys, so I want to make sure I address your specific needs. All right, first thing that I want everybody to write down. If you're taking notes digitally, great. If you're taking them by hand, great. Here's the first thing I want you to write down. The self-directed IRA, traditional IRA, the self-directed Roth IRA, the self-directed solo 401k. Those three accounts, those are the accounts that we're going to talk about. Now, you will learn that there's some other tax advantage accounts like a health savings account or a covered education savings account. But we're going to focus on the traditional IRA, Roth IRA, and solo 401k. And you'll understand why that is upon the conclusion of tonight's program. The accounts, here's the important part to take away here. Those accounts in of themselves, just the account on its own, will not positively contribute to your long-term or short-term financial goals. The account in of itself will not positively contribute to your long-term or short-term financial goals. Now, I know you probably might be thinking to yourself right now, wait a second, John, you represent a company, Equity Trust, that your product and service is a self-directed IRA, Roth IRA, solo 401k. The way that your organization is monetized with over 100,000 clients nationwide, with over $29 billion in assets under custody administration, is the product and service of the self-directed retirement plan. That is a fact. However, what I'm saying here is the account in of itself, just the account on its own, will not positively contribute. See, what you'll learn, it's the account plus positive, meaningful, and significant self-directed alternative asset investments that are generating income. So what we need to talk about in today's program is not just the accounts, but the accounts plus income producing real estate investment opportunities that are successful so that you can build a meaningful retirement portfolio. And that's what I intend on sharing with you this evening. Okay. So remember that. Now, if you're somebody out there that has an IRA or a 401k self-directed and you haven't done anything with the account yet, I see that all too frequently in the real estate investor space. That's okay. I'm glad you're here. And I'd encourage you to come to our March 13th event as well, our Saturday workshop, because that could potentially get the wheels turning and the motivation moving forward in terms of what you need to do to start jumpstarting that self-directed IRA. There's nothing worse than seeing money just sitting on the sidelines in self-directed IRAs and not being put to use. And guess what? We're seeing even more of that with the current uncertainty in the financial markets. Now, I'm not here to address the financial markets, that being the stock market, versus the alternative investment marketplace, that being real estate, gold and silver, cryptocurrency, privately held businesses, real estate private placements, real estate crowdfunding, so on and so forth. That's when I say alternative investments, those are the types of assets that I'm talking about. So I'm not here to disparage the stock market. What I am here to say is that I talk to investors every day that are looking to transition away and diversify away from the traditional financial markets and start moving and migrating their retirement portfolios into the private marketplace, particularly into real estate investments. I'm not here to tell you that that's the right way to go. And I know that there's a lot of people that are probably thinking, well, wait a second, my stock market portfolio has done phenomenally well in the past year and a half to 2 years. Well, I'll tell you, I've had a lot of people in my family circle that have come up to me and said I was absolutely crazy for buying real estate during the pandemic with my self-directed IRA. John, why would you buy real estate? You're making 15, 16% cash on cash return on that rental property. I made 18% in the stock market and I didn't have to do anything. You have to check on the property and you have to inspect it. And I hear about these calls you get from your tenants, so on and so forth. Why would you do such a thing? And what I remind them is that I have the confidence that that cash flowing asset is going to generate 16 to 17% cash on cash, plus the appreciation that I expect in the future consistently every single year, regardless of what happens in the traditional financial markets. If there's a downturn between now and 2023, I have the confidence that that particular asset is going to maintain stability from a cash flow perspective. So those are the types of conversations that I'm having. And it's interesting because when the pandemic hit and we saw the stock market slide in a very meaningful and significant way, those same family members were calling me. And I'm sure a lot of folks out there have probably had the same types of experiences. Were calling me 6 months prior. They were telling me I was crazy. And then they were calling me, asking me, what am I going to do? My portfolio just lost 20%. Now, fortunately, most of those people made their money back in the following weeks and months. But the point that I'm in the picture that I'm painting here is we really need to start looking at our retirement portfolios in a very objective way and determine are traditional investments like stocks and bonds or real estate investments more prudent for my portfolio. All right, so with all of that being said, I'm going to go ahead and share my screen now. And you will see as I go throughout the presentation, I'm going to share my screen so you see some slides. You'll see me over on my whiteboard a little bit here. I will make sure I draw your attention to it. So I will tell you whether I'm going to be at the whiteboard, if I'm going to be on the slides. That way, whether you're on a mobile device or a PC, you'll be able to follow along with me. So you will find as well that I give a lot of content and education when I do these presentations. So I will likely go pretty fast at times. I'm going to give you a lot of real client examples and case studies so you can really start to get the wheels turning on how you can do deals with these self-directed IRAs. So very quickly, it's important for me to mention Equity Trust Company. We have our trust company charter from the state of South Dakota. We are a regulated financial institution chartered out of South Dakota as a directed IRA custodian. What that means is you provide us the direction to process your real estate and other alternative investment transactions. What we don't do is provide tax, legal, or financial advice. So tonight's program is for educational purposes only. In terms of alternative assets that we custody all types of alternative assets, from real estate to cryptocurrency to gold and silver to privately held companies. In 2009, I had an investor come to me that wanted to buy privately held shares of Facebook, which he was able to do with his self-directed IRA through Equity Trust. Just as an example, you can invest in very unique exotic assets like thoroughbred horses. Just last week, I had a gentleman that came to me that wanted to buy 50% interest in a thoroughbred horse for $300,000. So that was a $300,000 investment in a racehorse. So Equity Trust, we are set up as a financial institution that can custody these unique alternative assets, whereas most other financial institutions are only set up to be able to accommodate traditional investments like stocks, bonds, and mutual funds. So when you're looking into self-directed IRAs, it's important to understand that self-directed is merely an industry term. It indicates to you that you have the capability to be able to invest in the assets that you deem best fit for your portfolio. You're not going to be limited to a menu list of mutual funds, ETFs, or other traditional investments. So with that being said, I'm going to jump right into a couple case studies to get the wheels turning. And then what I'm going to do is I'm going to circle back to, okay, what's the difference between a traditional IRA and a Roth IRA? What type of account do I want to start looking into? What's a solo 401k? How does it work? And address some of the questions that I saw coming in here. So my first case study that I wanted to share with you is from a family right outside of Cleveland, Ohio, which is in my hometown. And this is Gary and Candace. And Gary and Candace, they have a very unique situation. I shouldn't say more unique than other investors, but Gary and Candace's story goes like this. Back in 2010, Gary and Candace came to Equity Trust Company, and they, like many other investors, their retirement portfolios were decimated in the Great Recession in 2008 and 2009. They recovered, and then in 2010, Candace had a 401k from her old employer, and she rolled that 401k over into a self-directed traditional IRA. And you'll learn why she did it that way. It's called a direct rollover, no taxes or penalties. So once she had the money rolled over into her self-directed traditional IRA, she was then able to go out and start buying real estate. So in 2010, she did her first fix and flip deal in her self-directed IRA. She has made loans to other real estate investors. So you'll learn that your IRA not only can own real estate, but your IRA can also, your IRA not only can own real estate, but it also can loan money secured by real estate. So if you're somebody that's in the note business, if you're already lending money secured by real estate, or you're buying notes, that can all be done in the self-directed IRA as well. So let's take a look, fast forward to 2017. This is a foreclosure that was bought by Candace's self-directed traditional IRA. So her traditional IRA bought this property, and you'll notice there's a reason why I'm emphasizing her IRA bought the property, because what you'll learn in this business is your IRA will buy the property. Your IRA will take title to the property. Your IRA will pay for all fix up and repairs, and then all profits are going to go back into your IRA. I'm going to go through the logistics and mechanics of that in a little bit more detail in just a moment. But following along in this case study with me, Candace bought this property. It was a foreclosure for $80,100. She actually bought it at a sheriff sale auction. She put $18,000 worth of work into the house. She was in it for $98,100. So it was an all cash deal. She didn't have any debt. There's no loan on the deal. It's her IRA as a cash buyer, buying it, putting in the repairs, in it for 98.1, sold it for 144.9, had 10,000 in closing costs. Her IRA, her traditional IRA, made $36,800. So a lot of folks were asking about tax advantages. So what's really important to understand is that your self-directed IRA is a tax-exempt entity. Tax-exempt entity. What does that mean? Well, let's compare it to a taxable environment. So let's say Candace did this same deal that you're seeing on your screen here, and she did it with her taxable account. She'd pay taxes. Now this is short-term capital gains tax. Short-term capital gains tax, we do $36,800. $36,800 times her short-term capital gains tax rate, which is her ordinary income tax rate. In that year, her tax rate was 30%. So if we look at and we do the math on this particular transaction, we take 30% on $36,800. And if you're at home, I'll do a little bit of math. I'm not going to be overly math-based in this presentation, but if you follow along with me, that'd be $11,040 in taxes. So she doesn't make a 36% return on investment if she does this deal outside of her IRA with her taxable funds. She'd only be at 36.8 less 11,000. So she'd be at about 20, call it 25% cash on cash return on investment. So what you start to learn with self-directed IRAs is that you could potentially increase your yield as a result of eliminating the tax. If you can increase your yield, then you can get to your retirement goals in a shorter period of time. Foundationally, that's what I've been teaching investors for over a decade, is how to get to their retirement goals and their financial goals in a shorter period of time. Let me give you another example of getting to your retirement goals and financial goals in a shorter period of time. I'm going to go over to the whiteboard. So anybody that's not looking at their screen, follow me over to the whiteboard. So I have two investors here at Equity Trust, Scott and Christine. Scott and Christine, they came to me at about 2010 as well. You'll find there are a lot of real estate investors that started this back in 2010. And you know what's interesting is now as we see the cycle shifting, I'm starting to see some of the same patterns in 2010 today. So Scott and Christine, they set up self-directed IRAs back in 2010. They had 401ks. They rolled those over into traditional IRAs. They then opened up Roth IRAs, and you'll learn why they did this in a little bit here. So they opened up Roth IRAs and they started doing deals with those accounts. Now, fast forward to about 7 or 8 months ago, Scott came to me with a deal. Here's the deal that Scott came to me with. It was a storage facility. All right. Is anybody, by the way, you're going to have to excuse some of my drawings. Okay. I'm not a pro, but you'll understand the concepts. You'll see the numbers. All right. Scott, and by the way, I should ask, is anybody involved in storage, self-storage? If anybody's involved in self-storage, go ahead and put it in the chat box right now. Let me know if you're involved in self-storage or if that's something that you want to get involved in. So he finds deals. So Scott's good at finding deals. Scott's challenge with his Roth IRA is that he doesn't have thousands upon thousands of dollars or millions of dollars in some cases to take down an entire self-storage opportunity. But he's good at finding self-storage deals. He does it inside and outside of his IRA. So here's what Scott did. He found a storage deal. This particular property, the full acquisition was nearly $1 million. Scott did not have $1 million in his Roth IRA. Most people I know do not have $1 million in their Roth IRA. I do come across them once in a while. And I, of course, my goal is to have over $1 million in my Roth IRA. That's why I invest as aggressively as I can with that account. But most people don't. Scott doesn't either. Scott at this time only had in actual cash, he had some other investments in there, with actually only in cash, he only had maybe around $15,000 in the Roth IRA. What Scott was able to do is put the property under contract with a real estate option. If anybody is familiar with real estate options, put that in the chat box as well. If you're not familiar with real estate options, there's a ton of great education out there on how to take advantage of real estate options. I'm sure within this, in fact, I know for a fact within this St. Louis RIA group that there are individuals that have experience with real estate options. Why? Because I've been out to the market and I've talked to the investors that are part of the group. And I know for a fact that there's individuals that have experience with this. So here's what you do. And here's what Scott did. He put the property under contract with a real estate option. The only difference between using an IRA and not using an IRA is instead of Scott putting this deal in the name of his LLC or himself personally, he put the deal in the name of his Roth IRA. So the optionee on the option contract, instead of it being Scott, it was Equity Trust Company Custodian, FBO as in for benefit of, his Roth IRA, his account number Roth IRA. You'll actually learn that that titling convention is very important when you buy properties with your IRA or put properties under contract. You don't want to put a property under contract in your personal name or a LLC. You put it in the name of your Equity Trust IRA. In fact, you'll learn in our training and in our systems and utilizing our online technology platform that you don't need an LLC, contrary to popular belief. When you're doing deals with your IRA, you do not need an LLC or trust, personal property trust, land trust, title holding trust. You can buy properties directly in the name of the IRA. Now, I'm speaking a little bit louder here and I'm speaking passionately because I want everybody to be very clear in understanding that. You do not need an LLC, trust, title holding trust, land trust to buy properties with your IRA. Your IRA is a trust in of itself and can take direct title to properties. Having all that being said, there are some fringe cases. These are the rare, not the common. There are some fringe cases where investors will utilize an LLC structure for their IRA deals. And there are some good reasons for that. But again, that's the rare, not the common. So I'm showing you how to be able to do deals in a very simplistic way, in a very low cost way, so that you don't have to form an LLC, pay the extra fees associated with, because by the way, an LLC compliant with an IRA, there are prohibited transaction and disqualified persons rules under 4975 of the tax code. You have to understand those. You can't just go to any attorney and have them draft an operating agreement for your IRA. It's a very specially crafted operating agreement, and those can cost anywhere between $2,000 to $5,000 to set up properly. Now, can you go somewhere and maybe get the assembly line fashion operating agreement? You probably could, but you could potentially have holes in that operating agreement that could ultimately put your self-directed IRA at very, very great risk. The risk being a prohibited transaction. A prohibited transaction in your IRA results in your IRA becoming fully distributed, which means no tax benefits for that retirement plan anymore. So in some more advanced training, we do talk a little bit more about that. But again, in summary of this small segment that I'm referring to here, very important to understand that your IRA can take direct title to properties. All right, so back to Scott, real estate option. Puts the self-storage facility under contract with a real estate option. The real estate option fee is $2,000. So self-directed Roth IRA puts $2,000 down, made payable to the seller. This is an A to B to C transaction. So Scott puts the property under contract with the seller. Scott's Roth IRA is player B here. Okay. Then Scott, with this assignable option contract, assigns the contract to a end buyer that has the cash and the leverage to close on the deal. Scott's Roth IRA is now out of the picture, and A and C close on the deal. Scott's Roth IRA, assigning the contract because he's the one who found the deal, got it under contract, negotiated the deal, worked with the end buyer, made a $20,000 assignment fee. So Roth IRA makes a $2,000 investment. Roth IRA collects a $20,000 assignment fee. Now, folks, that's tax-free. It's tax-free because the Roth IRA is a tax-exempt entity. So there is no short-term capital gains tax on this particular transaction. No short-term capital gains tax on this particular transaction. Now, I will add a slight caveat to this that you'll learn about in some other training. In fact, I have a YouTube video on this as well online. It's called Unrelated Business Income Tax. So I want to be cautious. I'm sharing with you how to do one or two of these types of transactions a year. If you start taking your IRA and running it like a full bore real estate business, there could potentially be some tax that comes up, which is known as unrelated business income tax. So you want to be careful of that as you move along. All of that being said, real estate options can be a great way to grow a smaller IRA in a fairly short period of time. Okay, now back to our slide presentation. So I'm back on the slides. Another transaction from Candace. This is a fix and flip deal. She bought this house for $77,000, put $23,000 worth of work into it, in it for $100,000, sold it for $165,000, 4,800 concessions, had $13,000 in closing costs, and made a net tax exempt profit of $47,200. So that $47,200 tax exempt in her IRA. Had she paid taxes on the deal at a 30% tax rate, she would have been paying anywhere between $13,000 to $14,000 in taxes on that particular transaction. She does it in her IRA, and it's tax exempt. Again, we're increasing our yield. By increasing our yield, we can get to our retirement goals in a shorter period of time. All right, so now that you understand that, I'm going to go back to the whiteboard here because what I want to share with you is the mechanics of utilizing a self-directed IRA to buy and sell real estate. All right, this is really, really important. I know there were some questions that folks had about in some of the comments that came up about those specifics. Okay, how do I actually do this? How do I put it together? So here's what I'm going to do for you is I'm going to share with you an example. This is just a real high level, we'll call it a rental property type opportunity. We're going to buy a house for $90,000. We're going to put $10,000 worth of work into it. So we're in the deal for $100,000. It's going to be an all cash deal. You're going to learn why IRAs typically don't borrow money to buy properties. I'll talk about that. The property is renting out for $1,200 a month. The annual gross rents is $14,400. The net operating income is $10,000. So we're making a 10% return on investment. So step number one is you need to have your self-directed IRA open and funded with the custodian that you want to do business with. So if you like the idea of working with Equity Trust Company, you want to become a client of Equity Trust Company, of course, we can help you with that process. You would open your account with Equity Trust. We will help transfer or rollover funds from your existing IRA or 401k or wherever the funds are at. And then once the funds are in place at the Equity Trust IRA, you can then begin deploying those funds for your real estate transaction. But the account's got to be set up and funded well in advance. The number one pitfall that I see in this industry and in this business is investors will fail to have their account open and funded. I did a workshop just like this to a group on the West Coast 6 months ago. 3 days ago, I got a call from the gentleman that came to the class, even despite me saying what I'm about to say and what I am saying here. And he said, John, we finally found the deal. We're under contract and I wrote an earnest money deposit. And I need to open my account and we need to fund the deal within 15 days. And I'm thinking to myself at that point, why did I spend that time in that seminar passionately speaking about why not to do this? Lo and behold, it happens. And I can almost guarantee that it's going to happen in tonight. That's just the way it is. And maybe someone will prove me wrong, but it always seems to happen. We talk about these types of things in these seminars and conferences. Don't make these mistakes, and someone always ends up making that mistake. So please forgive my candidness, but I've been doing this a really long time, and it's a pattern that I've not been able to break, unfortunately. So I feel like if I become more candid and more candid, maybe things will change. So open your account, fund it well in advance. You'll be up and running. That way you don't miss out on a deal. Now, some of you might be thinking, well, wait a second, why is that? I can move an account from Bank of America to Chase Bank overnight. Well, that's a taxable account. When you have an IRA, you got to remember that that financial institution isn't always willing to give up the money overnight. It can take sometimes just a couple days. Sometimes it could take upwards of 3 to 4 weeks to move money from point A to point B. So you want to make sure the account's up and running. All right, so that aside, account is up and running. We're ready to go. We're ready to buy the property for $100,000. We're going to put $10,000 worth of work into it, and we're going to rent it out. We need to enter into a contract, and we need an earnest money deposit, right? So here's how you enter into a contract with your self-directed IRA. It's not in the name of your LLC. It's not in your trust. It's not in your name. It's not in your wife's name. It's not in your brother's name. It's in your Equity Trust IRA. I am going to type in the chat box for everybody right now the titling that you're going to use, and I'm going to speak it out loud and talk slowly so that we all understand, because if you're going to go out and make deals following this seminar, you want to make sure you use this titling. Equity Trust Company Custodian. Equity Trust Company Custodian. Why custodian? Equity Trust is your custodian. So Equity Trust Company Custodian, FBO, which stands for the benefit of, your name or your account number. Does anyone know why we would use our account number instead of our name? We would use that for anonymity or privacy. So your name won't show up. Your personal name will not show up on public record. That's a benefit of using an IRA trust, that you have some additional anonymity or privacy. Equity Trust Company Custodian, FBO, your name or account number, IRA. It's posted in the chat box for everybody, so you can copy and paste that. So why is this so important? Well, that's your IRA. In order to take advantage of the tax privileges, in order to properly, legally have the right title to the property, you need to make sure you use that titling. And do not deviate from that. I have so many people that call me after I give them that titling, and the title company decides that they want to do their own thing. They want to put equity trust, care of, they do all kinds of things, not what I told them to do. So make sure you give the title company that specific titling, or when you enter the name on your contract, the buyer is listed as such. Very, very important. In fact, we've had so many challenges with title companies over the years. We actually went out and built a relationship with a title company called IRA Title Pro. And so in qualifying states, we can actually help you close on the entire deal in a fully integrated fashion. So we have actually gone out and developed partnerships with various individuals within the real estate investing supply chain to make it easier and more accommodating for you to be able to close on real estate transactions. So you can follow up with us individually, and we can work with you on if that title company will be able to provide services in the state in which you're buying properties. So that question just came up on how do I sign for the property? So you would use your standard John Hancock. So you're signing on behalf of your IRA. You are the account owner. You have full discretion to make all decisions on behalf of your IRA. So as far as a purchase contract is concerned, you're going to sign the purchase contract. The only instance where Equity Trust might get involved in signing documents is at closing. Some title companies, for whatever reason, they don't want you to sign the documents. They say, well, Equity Trust is the IRA trustee. Even though we're not a fiduciary trustee, we're a trustee custodian. They sometimes will want us to sign documents. That's okay. We have an entire real estate closing process that's integrated into our online management system where you can upload the documents, and then our corporate signers sign them and send them right off to the title company. You actually give us authorization to work directly with the title company, interface with the title company, and we help coordinate that entire transaction. So if there are documents that we need to sign, we can help you with that. But again, documents that you would sign, you're signing on behalf of your IRA, just using your standard signature. All righty. So you have a contract, and now you need an earnest money deposit. So let's say on this particular $90,000 purchase, you need a $5,000 earnest money deposit. So the way you're going to coordinate this is you're going to log in to your Equity Trust My Equity digital processing portal. So this is an online system which is going to allow you to process your transaction in real time from the comfort of your own home without per se having to make a phone call or walk through a physical form. Now, if you need to call us and you need us to walk you through the transaction, we are here and available to help you through that process. So showing on your screen right now is a snapshot of this online management system. So when you're ready to buy real estate, you're simply navigating to real estate and you're going to process an earnest money deposit. So you're going to simply go through this wizard. We're going to ask you a series of questions. And then from there, you're going to actually be able to process the transaction all digitally. So it's not necessary for you to physically mail documents in or physically upload documents. You're able to simply process this transaction from end to end through the online MyEquity portal. Then when you're back in the mix of actually processing the real estate purchase, so you need the $85,000 wire transfer to the title company, you're going to go back into this online portal. If you have documentation that you need to upload for us to sign, there's a point in time where you're going to be asked for that information and you're going to upload that into the system. And then we're going to sign the pertinent documents and overnight those to your title company. So you're able to use this online management system to process the entire real estate transaction from end to end. You will see, by the way, in this online portal, you're able to process private loan investments. You can invest in mutual funds through the platform. We have in-house brokerage services, cryptocurrency. You're able to pay for all of your expenses related to your property through our online bill pay feature. So we'll get to that in a second. So this is really your online management tool for all the bookkeeping, all the record keeping, all of the processing of all of your investments and transactions. All right, so now back to our scenario here. We have $10,000 in renovation costs. So those expenses absolutely must be paid for from the IRA. So if you're new to this, it's important to understand that if your IRA owns a property, your IRA must pay for all fix-up and repairs. You personally can't go out and pay for a fluid master and flapper and install it yourself. Your IRA's got to pay for all those expenses. How do you do that? Going back to that MyEquity portal that I just showed you, all of your expenses are going to be paid via this online virtual wallet. So you don't need to submit invoices or receipts. You simply log in online, request a check or checks, and we'll mail those out to you. Or you can send an ACH direct deposit. So if you have a contractor and they need $5,000 in the next 48 hours, you go in online, you key in the bank account number and routing number, the money is direct deposited into that contractor's bank account. All right, so that's the process for paying for the $10,000 in expenses. Now from there, we have rental income coming back in. So our rental income is $1,200 a month. So every month we get a check from the tenant, let's say for $1,200, made payable to our Equity Trust IRA. So how do you make the check payable? Equity Trust Company, custodian for the benefit of your name or account number IRA. A lot of people like to use their account number. In fact, they represent their IRA as the manager of the property. So when they're talking to their tenants, they're the manager of the Equity Trust Company custodian for the benefit of account number 123456 IRA. So that's a great way to separate the account owner from their IRA owned asset, which is the property, in interfacing and facing off with their tenants. So the tenant makes a check payable to the IRA. That is the one instance, by the way, where you can abbreviate the check. So the tenant could put ETC custodian or ETC care of, and then your account number IRA, because that's a check. As long as it has that variation, we can get that deposited for you. Now, we also have a technology portal that allows you to have your tenant send an ACH direct deposit. So think of like Zillow management or cozy.co management, where you have a portal and the tenant sends in a direct bank draft. It's the same process here with your IRA. So we've built a technology where you simply send a link to your tenant, they key in the account number, routing number, and then the money is zapped directly back into your Equity Trust IRA. The great thing about this online portal is it has all the bookkeeping and record keeping built into the account for you. So you don't have to manage a separate spreadsheet or separate books and records for your equity trust IRA. From an audit perspective, that can put you at an advantage because you have all the systems and all the tools in place. And that's why it's really important as well that you're buying real estate and owning real estate directly through this IRA account. So that's the process to buy a property and manage a property with your self-directed IRA so that everybody can understand a little bit better on what those logistics and mechanics look like. The last thing that I'll mention on this item is the initial transfer or rollover from your IRA or 401k, wherever it's coming from. There's no tax liabilities or penalties. You're simply moving from one IRA to another. One of the most common misconceptions I find in the industry is investors will think that by rolling over or transferring funds from another retirement plan into a self-directed IRA, that there's some sort of tax consequences or penalties. You're just moving from one retirement account to another. All right, secondarily, it's important to understand for those of you that are newer, that when you buy real estate with your IRA, it's looked at no differently than a stock or mutual fund transaction. So when you buy a stock or mutual fund, cash leaves the account. In return for that cash is a stock certificate. When you buy real estate, it's the same process. Cash leaves the account. In return for that cash is a deed to a property. If you make a loan to another investor, so you're in the note space, if you make a loan or you buy a note, cash leaves the account. In return for that cash is a note and mortgage or note and deed of trust. So that's the actual asset. When you buy real estate with your IRA, you're not borrowing against the IRA. You're not taking a distribution. Again, you're buying an asset. That's very critical for you to understand from a logistical perspective, to understand how to do this in a tax advantaged way. All right, so that's the example that I wanted to give to you to walk you through actual rental property, an example of a rental property. If you were to do a fix and flip deal, for example, it's really the same concept. Difference is you're going to sell the property and then cash is going to go back into your IRA. All right, let me flip back to my slide presentation here because I have a few more examples to share with you. And before I go back into a few more examples, let me touch on the difference between a traditional IRA and a Roth IRA for everybody. So I'm going to give you an example, a time value money compounding interest example to paint the picture for you. So let's say, for instance, that we are going to put away $6,000 per year for the next 25 years. And every year that we put $6,000 in the account, we're going to assume a growth rate of 12%. So $6,000 a year for 25 years at a compounding return of 12% every year. We're going to factor in taxes, of course, because we need to do that in our time value money example, of 30% during our years of contribution and 20% during our years of distribution. In fact, we're going to distribute in this hypothetical example all at the 25-year mark. So if I take these numbers and I put it into my financial calculator, it's going to give me $601,000 saved in a taxable environment. So when we talk the taxable environment, we're talking about every dollar we make, a percentage of that dollar is carved off and given to the IRS in the form of taxes. That could be short-term capital gains tax, which is our ordinary income tax rate. It could be long-term capital gains tax rate. It could be ordinary income tax on interest income that we earn. So if we're in the lending business or note business and we generate interest income, just like a savings account, is subject to ordinary income tax rates. So we need to apply those different tax categories to our analysis. In this example, we're going to focus on ordinary income tax rate of 30%. So in our taxable environment, we have $601,000 saved. Again, every year as we earn, a percentage of those earnings have to be paid in the form of taxes. Now we move over to the traditional IRA environment. With a traditional IRA, known as a tax-deferred, tax-deductible IRA, we have $894,000 saved. So our tax savings between our traditional IRA environment and taxable environment is about $300,000. Why is that? Well, a traditional IRA is tax-deferred, meaning every year we generate income, we pay 0% tax on the income that we generate in each of those given years. It's not until we take money out of the traditional IRA after the qualified retirement age of 59 and a half that we have to pay taxes. So remember that with a traditional IRA, it's tax deferred. meaning that we're exempt from taxes in each incremental year as we grow. And then when we take money out after the qualified retirement age of 59.5, that's when we pay taxes. The analogy that's used in the industry, and some of you may have heard this before, I think I saw David on the call. I know he's very familiar with the difference between traditional and Roths. With a traditional IRA, you don't pay taxes on the seed, so you have to pay taxes on the crop. So just remember this seed and crop analogy. So you don't pay taxes on the seed, you have to pay taxes on the crop. When we take money out of the traditional IRA, we pay taxes based on our ordinary income tax rate. So for example, let's say we grow our traditional IRA to $1 million. And let's say at the age of 60, we take a $100,000 distribution. That $100,000 is going to be added to our ordinary income, and then we pay taxes accordingly. So let's say at 60 years old, we're at a 20% effective tax rate. 20% of 100,000 is 20,000. So with a traditional IRA, we take 100,000 out, we get to keep 80,000, and then 20,000 has to be set aside to pay taxes. That's how a traditional IRA works. There's still benefits with the traditional IRA because of the tax deferred growth. But then we move over to the Roth IRA, which is certainly a fan favorite for many investors, of course, and you'll see why from a compounding interest perspective. But the traditional IRA is still beneficial, so don't get me wrong when I speak passionately about the Roth IRA. With the Roth IRA in this scenario, you see $1.117 million saved. So when we compare the Roth IRA to the traditional IRA, we have 200,000 plus in savings. When we compare the Roth to the taxable environment, we have $516,000 in savings. The Roth IRA is the opposite of a traditional IRA. When we put money into the Roth IRA, it's after tax. It grows tax-free. When we take it out after 59.5, we pay 0% tax. Using our seed and crop analogy, we get the taxes out of the way in the seed, so we don't have to pay it on the proverbial crop. You'll learn in some of our more advanced training that if you're told that you don't qualify for a contribution to a Roth IRA because you're over the modified adjusted gross income limits, you might surprise yourself and learn that you do qualify. You just have to go about it a little different way. You have to do what is called a backdoor Roth contribution, meaning you first contribute to a traditional IRA and then you convert over to a Roth IRA. In some of our other training, we also talk about a conversion from a traditional to a Roth IRA. So if you have traditional IRA funds and you want to get the taxes out of the way in the seed so you don't have to pay it on the much larger crop, you can actually convert portions or all of your traditional IRA to a Roth IRA, get the taxes out of the way now so you don't have to pay it in the future. In fact, to the St. Louis market here, I have two investors that came to us in 2010, a husband and wife, and for anonymity or privacy purposes, I won't say their name, but they came to Equity Trust and they started with only about $100,000. And they have since, through a series of fix and flip transactions, private lending, rental properties, they've grown their accounts to well over $1 million. And in 2010, they took their approximately $100,000 and converted it to a Roth IRA, paid about $30,000 in taxes at that time, but now they have well over $1 million plus in properties and cash. So you can imagine they predicted that they were going to be able to grow that account in that significant of a way. And they knew that in the long term, they would pay way more in taxes than they did back in 2010. So that's the analysis you need to do. You need to determine, will I pay more in taxes on the seed or more on the crop? For a lot of very active real estate investors, most will forecast, not all, but again, most will forecast that through accelerated growth in their Roth IRA, if they didn't convert it from a traditional to a Roth, they would end up paying far more in taxes than if they converted it on the seed many, many years ago. So think about that as you move along. And we do have some additional content around how to convert from a traditional IRA to a Roth IRA. So that's the traditional and Roth IRA explanation for you. Now let me touch on contribution limits. So how much can you contribute to an IRA, traditional or Roth? You can contribute to a traditional IRA or Roth IRA when you are under the age of 50 when you are under the age of 50, you can contribute up to $6,000. When you're under the age of 50, you can contribute up to $6,000. Hopefully you can see that okay. Let me make that a little bit bigger for everybody so you can see it. When you are under the age of 50, you can contribute up to $6,000. When you're 50 and over, you can contribute up to $7,000. This is for both a traditional and Roth. Now, if you are in a position where you have an old 401k or an IRA, you can roll over or transfer those funds into a self-directed IRA. Okay, you're not limited to the 6 or 7. The 6 or 7 is just if you want to make an out-of-pocket contribution to the plan. Now, keep in mind that if you have a spouse, even if they're not working, so you got to have earned income to make a contribution to an IRA. If you have earned income and your spouse doesn't, that's okay. Your earned income can support your spouse's contributions. So for example, I have an individual that came to me in 2019, came to one of our seminars, and he didn't know about this capability of being able to contribute to his Roth and his wife's Roth in the same year. So over the last 2 years, he's gotten 7,000. He's over 50. He's gotten 7,000 into his for 2019, 7,000 for 2020. And then his wife did the same, 7 and 7. So in 2 years' time, as a combined couple, they created $28,000 in Roth dollars. And now he's able to take that money and start investing in notes, partnering with his non-IRA funds. So those are the contribution limits for an IRA. Keep in mind, prior to April 15th, as we are still in this window of time, prior to April 15th, you can make a contribution for 2020 and 2021 all at the same time, because you have until tax filing deadline April 15th to make a 2020 contribution. So if you miss the boat for 2020, you still have an opportunity to hop back in. You can still make your 2020 contribution. So you're starting to see here how you can get a significant amount of money in an account as a contribution in a short period of time. In a few moments, I'll talk about a self-directed solo 401k and what the contribution limits are for those accounts. All right, let me now go back to the slides with everybody because I want to share with you some more deals. This is Gary, Candace's husband. Gary's situation goes like this. In 2010, he only had $5,000 in his Roth IRA. What did he do with $5,000 to get it going, to get it growing? What he did is he started doing real estate options, just like Scott, who I showed you, who did the $2,000 self-storage deal. He started doing real estate options and wholesaling deals. So putting a property under contract, assigning the contract. So he would do a couple of those a year to build the account. Fast forward to 2018-ish, and Gary had this deal, and he needed $72,000 for the deal, $41,500 for the purchase and $30,000 in rehab. It was a fix and flip deal right outside of Cleveland, Ohio, in a city called Maple Heights. The challenge that Gary had at this time is he only had $62,000 in his Roth IRA. So he had a gap of $10,000. So what Gary did is he partnered his Roth IRA with his non-IRA funds to buy the property for $41,500. At closing, his Roth IRA funded $31,125 of the $41,500 for 75% ownership interest. Gary's LLC came in as a 25% partner at $10,375. So using that same titling that I showed you before, in this instance, you're going to see a undivided interest titling. So the titling is as such: Equity Trust Company Custodian, FBO is in for benefit of, Gary's IRA, undivided interest 75%, and his LLC, undivided interest 25%. So it's a 75%, 25% split. The repair costs were $30,000. So those repair costs were split up 75-25. Why am I telling you that the repair costs have to be split up 75-25? Well, what you'll learn about self-directed IRAs is that there are what are called disqualified persons to your IRA. Disqualified persons include you to your IRA, your spouse, your children, your parents, your grandparents, your grandchildren. Anyone up and down the family tree is a disqualified person to your IRA, your spouse, and then, oh, by the way, any entity like an LLC that you own and operate. And so what the tax code says is that you can't self-deal, you can't create transactions. So if you're going to partner with yourself or your spouse or those other family members, you have to make sure that everything is done proportionately. And when I say proportionately, I mean proportionate to the capital contribution. So that's exactly what Gary is doing in this example. His IRA partnered with his LLC. He entered into a tenants in common arrangement. IRA as 75%, LLC Untitled as 25%, sold the property for $116,000, had $10,000 in closing costs. The Roth IRA received 75% of the profits, right? Because the Roth IRA had 75% interest, therefore the Roth IRA makes 75% of the profits. That leaves his Roth IRA with nearly $26,000 tax-free. No taxes on those gains, of course. Then back to his LLC is $8,600, which of course is taxable because that's his non-IRA environment. That's his taxable environment. So this is a great example of how you can do fix and flip deals, partnering your IRA with your non-IRA funds. If you don't have enough money in your IRA, IRA partners with non-IRA funds. And then in a few moments, I'm going to share with you, what if your IRA partnered with a non-disqualified person, a non-family member? What can that type of deal look like? All right, before I do that, another example from Gary. This is a simple rental property purchase. Gary bought this property for $68,000 at a foreclosure auction, put $20,000 worth of work into it. He's renting it out for $950 on unit A and $900 on unit B. So it's a upper and lower double, $950, $900 at $1,850 on a monthly basis gross. The net operating income is $1,400. This is in his Roth IRA, so that $1,400 is tax-free coming in every single month. Now, Gary is getting close to the age of 59 and a half, which is that qualified retirement age. So at 59 and a half, should he decide every month he wants that $1,400 in cash flow, it's all tax-free. There's no Schedule E. There's no 1040 reporting. It's all tax exempt in his IRA. Now, I said something there very important that I'll pause on. The IRA does not have a tax return. When you buy mutual funds or stocks with your IRA, where on your tax return do you have to report dividend income? Or where do you have to report the long-term gains on the sale of a stock or mutual fund in your IRA? You don't, because it's a tax-exempt entity. It's the same process with an IRA. One of the reasons why my clients and why I really enjoy the simplicity of self-directed IRA investing, because if I do everything properly, there's no tax return for the IRA. It's all tax exempt in the account. It's not until I take personal distributions that I have to report that on my tax return. With a Roth IRA, however, it's 0% tax. Still reportable, but it's 0% tax on my distributions. So as long as I'm taking out after 59 and a half. So that is Gary. Now the property has a after repair value of 140. So the reason why I'm sharing this with you is, yes, because it has some significant appreciation. If he were to sell the property, he'd make about a $40,000 profit. That long-term gain is not taxable in the Roth IRA. There's no recapture depreciation because the IRA did not have any income to offset using the depreciation over the years that we own the rental property. Another advantage, another tax advantage of the IRA. And a lot of people asked about tax advantages, so I'm trying to really make sure I address those points here. All right, so that's Gary with a rental property. Let me show you one of the deals in my current portfolio. This is a rental that I bought in March of 2020. And at the time of buying the property, I actually bought it from a wholesaler who I met at my local real estate investor association. So I met this wholesaler. They knew that I wanted to invest in this market. I would say a month later, they called me with this deal. They're asking 73. We got it under contract for 63 after some negotiation. At the time of buying the property, I did not have 63,000 in my Roth IRA. Why? Because I'm not fortunate to have just millions of dollars sitting in my Roth IRA, just like everybody else out there. Folks, I'm a part-time real estate investor, full-time equity trust, full-time teaching investors across the country. I plan to get to the $1 million plus that I so admire from so many people that have walked before me. But I am not in a situation right now where I have millions of dollars in my Roth IRA to just be able to go out and do deals whenever they present themselves. I have loans in my Roth IRA to other investors. I have other assets. So I'm not always in a position where when a deal presents itself, I can pull the trigger and make an offer and do it all with my Roth IRA. And I say that because I know there's probably a lot of people on today's call that are in that same situation. And if you're not in that same situation today, you might be in the future. So it's important to listen to case studies like this so you can understand how to potentially do deals, even if you think you don't have enough money in the IRA. So I bought this house for $63,000. I partnered my Roth IRA at 55%, my traditional IRA at 35%, and then my LLC at 10%. So I personally have a 10% ownership interest. My traditional IRA has a 35% ownership interest, and my Roth has a 55% ownership interest. So yes, when you look at the deed on the property, this is what you see. Equity Trust Company, Custodian, FBO, my account number for my Roth IRA, undivided interest, my account number for my traditional, and my LLC, 55, 35, 10. I had $2,000 in repairs to clear the point on sale inspection. Those repair costs were all paid for 55, 35, and 10%. So I used my Equity Trust online, my equity portal to request checks made payable to my handyman and contractor, sent out. I give them to the contractor. They deposit the funds. Those are expenses related to my property in my IRA. I have those allocated to the property in my IRA. So when I request a bill pay from my IRA, I'm selecting the property that bill pay is used for. Good bookkeeping and record keeping, absolutely critical with the self-directed IRA. That's what the equity trust system does. Now, all of my profits, so I have rental income coming back in. I have two tenants, $750 on the upper and $750 on the lower, $1,500 in gross a month. Net operating income is about $1,200. That rental income goes directly back into the self-directed IRA. Okay. Now, in terms of managing the property, administrative oversight. Now, I do work on rental properties. I own rental properties outside of my IRA. If there's a tank gasket that needs to get repaired, which is one of my most recent repairs, if I need to put a fluid master and flapper in, I'm going to go over to the rental myself and I'm going to take care of that repair. Why? Because I've done hundreds of them in my career prior to Equity Trust. That being said, I know that with my rental properties in my IRA, even though I know how to do the work, even though I have in my basement in overstock fluid masters and flappers and tank gaskets and all types of plumbing parts, I do not do the physical work on my IRA owned properties. Why? Because Internal Revenue Code 4975 states that if I, as a disqualified person, furnish a service to my IRA, that is a prohibited transaction. It's a bit of a gray area. It's not overly cut and dry, but what I will tell you is the rule of thumb to use in the industry is you can do the desk work, but you shouldn't do the sweat equity. So what I'm doing is talking to tenants. Got a text from the last tenant. They told me when they were going to send the direct deposit into my IRA. Okay. I'm talking to tenants. I have another tenant that we're up for a lease. So I already have a lease printed out and I'm going to go over in about a week or so and they're going to sign a new lease. All right. I'm going to scan that into my system and I'm going to make sure I keep my records there. Okay. I am doing the administrative oversight. All of that being said, some people, they prefer to hire a property manager, and that's okay too. You can manage it on your own, or you can hire a property management company. From an equity trust perspective, we are the directed custodian. We are unbiased in terms of whether you self-manage or hire someone to manage the asset. All of that being said, you do have to, again, make sure you're following the rules and the guidelines of the Internal Revenue Code 4975, and you're not doing the physical work. Some people who own lots of properties in their IRA, they don't want to put their IRA at risk of engaging in a prohibited transaction. So they hire a property management company so that they can make sure that they insulate themselves from potentially being viewed as engaging in a prohibited transaction. All right, so I wanted to make sure I touch on some of the rules for everybody as I talk through my particular rental property that I own in my self-directed IRA. All right, now we're getting close to the end here. I want to make sure I share with you this case study because it's one of the most powerful techniques that I'm finding people are utilizing and gaining success from. So Scott and Kate are investors out of, Milwaukee, Wisconsin. here's the way the story goes. Scott is a real estate investor. Scott found this deal. This is the actual property. And he needed $224,000 for the purchase and the carrying costs. So the only carrying costs that they were going to have, or costs they were going to have to get the property ready to be sold, were utilities, taxes, and insurance. The property didn't need any work whatsoever. So they bought it and essentially retail sold it. Scott needed $224,000 for the deal. Scott's problem was he had a Roth IRA with only $24,000 in the deal. So what Scott did is he brought in an investor partner, which is his investor partner, Kate. Kate is not of relation to Scott whatsoever. They're not married. They don't intend on being married. They're just investor friends. Okay. Kate's Roth IRA and HSA. By the way, we haven't even talked about a health savings account. You could actually self-direct an HSA, health savings account, into real estate. All tax-free, of course. So Kate brought in her Roth IRA and her HSA at $200,000. They created a real estate joint venture. So they had a joint venture agreement drafted. That joint venture agreement states that 30% of the profits are to go back to Kate's Roth IRA and HSA, and 70% are to go back to Scott's Roth IRA. Now, wait a second. You might be thinking to yourself, John, you just showed me that 75-25 deal. You just talked about your 55-35 and 10. Why is it a disproportionate percentage? Well, the reason why we can have a disproportionate percentage here is because there's no disqualified persons involved. Scott and Kate are just investor friends. They're not husband and wife. They're not brother. They're not father and daughter. They're not disqualified persons. Therefore, there can be a disproportionate allocation of the profits and expenses, and that's exactly what they did here. Now, you might also be thinking, wait a second, Kate is putting in $200,000. Scott's only putting $24,000 in, but Scott's getting 70% of the net profit. How is that possible? Well, Scott is the one who found the deal. Kate, her Roth IRA and HSA were making 0% sitting on the sidelines. Scott came along and made the offer and gave the opportunity to make 9% in 6 months, 18% annualized. So Kate is happy because she's putting her money to use and she's a passive money partner. Scott is in the driver's seat. He's the one who found the deal. He's putting this all together. He's the one who connected with the real estate attorney that drafted the 3.5-page real estate joint venture agreement. The money was sent from their IRAs at Equity Trust to the title company. The title company had all the funds escrowed. At closing, actually last Friday, wire transfers sent back to the Equity Trust IRAs, HSA, Roth IRA, and Scott's Roth IRA. Scott's Roth IRA made $42,000 tax-free. So he made a $24,000 investment and made a $42,000 profit tax-free. And Kate's Roth IRA and HSA made $18,000. So what do you need to do to get a deal done like this? One, you need a property, of course, right? You got to find a good fix and flip deal. And there could be rehab necessary. This one happened to not have rehab, but it could be a property that you need rehab. Typically, that's the way I see it done. You need a real estate attorney. I'm sure that the St. Louis RIA here has a reference for a real estate attorney. Okay, they can help out with that. So you need a real estate attorney to draft a joint venture agreement. You need a title company, of course, to be able to close the deal. And then you need a money partner, right? You got to network and find investors that have money sitting on the sidelines, maybe in IRAs or not in IRAs, and you bring them into the deal. And of course, last but not least, you need a self-directed IRA or self-directed solo 401k. Now, last but not least, you might be asking yourself the question, John, why did he bring her in as a joint venture partner? Why didn't he just bring her in as a private lender? Well, see, what you're going to learn about IRAs is when IRAs take on debt, the IRA has to pay a special tax called unrelated business income tax. I like to call it IRA tax. It's when your IRA takes on debt. Now, you will learn under a solo 401k, you could potentially be exempt from that. That's a benefit of a solo 401k. We'll get into that in just a second. But under an IRA, taking on debt means a more complex loan because it requires a non-recourse loan. Not all lenders will do it. And number two, you have this unrelated business income tax. And that tax rate could be as high as 37% for tax or for income, I should say rather, over about $13,000. It is applied to the estate and trust tax schedule. So when you look at the estate and trust tax schedule, any income over about $13,000 in 2021 is subject to a 37% tax rate. That's the IRA tax again, I call it. So Scott and Kate put together this joint venture deal so that they can mitigate that tax liability. All right, so keep in mind this real estate joint venture example because it can be really powerful. All right, self-directed solo 401k. Let's make sure we cover this. With a self-directed solo 401k, which is a highly powerful tool. I already mentioned one of the benefits of a self-directed solo 401k, that unrelated business income tax as it applies to leverage deals is exempt. That can be really powerful. The other benefit of a solo 401k you'll learn is you can make significantly higher contributions. Now, just like anything, when you have powerful features and tools, which a solo 401k is incredibly powerful, but with that comes responsibility and also comes eligibility. Not everybody qualifies for a solo 401k. Let me pause here for a moment and tell just a quick story because it just happened today. So I had a prospective client that called in and talked to one of my self-directed counselors. So I have a team of self-directed counselors, by the way, that after today's call, if you want to spend some time with them over the phone, they'll help educate you. And we take an unbiased, non-pressure approach to working with all of our clients. Why? Because we're a regulated financial institution. We have over 100,000 clients nationwide. We're the largest self-directed IRA custodian. We have a lot to lose. I will say candidly that there's a lot of folks out there that don't have as much to lose. And quite frankly, they ill-advise customers. I see it happen every day. Do your due diligence. I'm not here to overly promote EquityTrust. There's a lot of self-directed IRA custodians out there. Search self-directed IRA custodians, do your due diligence. If it turns out that EquityTrust is a right fit for you, great, we can help you. If not, that's okay too. But the story that I want to tell you is a gentleman called up and he's working with another self-directed IRA company. I'm not going to mention this particular name, but they're one of the larger ones. And he said, I want to open a self-directed solo 401k. And so my agent, my self-directed counselor, did exactly what they're told to do and they're instructed to do, is they vetted that particular client to make sure that they have active earned income, taxable wages in a business to support the self-directed solo 401k. So the gentleman said, well, I have 10 rental properties. I have passive income. Does that count? No, unfortunately, that's passive income. So passive income does not count. The way you know is active earned income is income that you're paying Medicare and Social Security tax on, payroll taxes. So if you're filing a Schedule C and a Schedule SE self-employment, okay, you got active earned income. You're good. You can open a solo 401k providing you meet the other requirements. But if you only have passive income, in this particular gentleman's case, all he had was passive income. He didn't have any active earned income. So he said, well, unfortunately, you don't qualify for right now. You don't qualify right now for the account. But we could help you with a self-directed IRA. You can open a self-directed IRA and you could buy properties with that account. And then maybe later down the road, when you do establish active earned income, then you could open up a self-directed solo 401k. So this particular gentleman unfortunately argued with us and said, well, this particular company said it's just fine. We can open up the solo 401k for you. We said, okay, well, let's go to the Iras website. So you go to the Iras website, iras.gov. By the way, you can check this out. And just type in iras.gov in the search box, recurring and substantial contributions. It states in black and white from the IRS that if you are not making recurring and substantial contributions to your solo 401k, that there is a discontinuation of the plan, which means the exempt benefits from UBIT don't apply to you anymore. The entire plan ceases to exist. It's a discontinuance of the solo 401k. It's stated black and white in the IRS guidelines on their website that you can't do that. Unfortunately, this gentleman is opening a solo 401k with this particular company. These are the stories, folks, that I hear every single day in our industry. And please forgive me if I'm overly passionate or candid about this particular topic, but I'm passionate and overly candid about the topic because I take this business incredibly seriously. This is my entire livelihood and my entire career. I'm not the type of person with some of these other organizations that's a salesperson that gets paid a commission, open accounts, move on to the next one, open accounts, move on to the next one. I have a full vested interest, as an organization does, in the livelihood of this industry. And so that's why I speak as candidly as I do. All of that being said, let's move on to the self-directed solo 401k contribution limits for everybody. So this is where you really start to see the power in the plan, if you have the active earned income. So if you are under the age of 50, put your employee hat on. You wear an employer hat and an employee hat. As an employer, you're going to see here, as an employee, you're going to see here that you can contribute up to $19,500 when you're under the age of 50. When you're 50 and over, you can contribute up to $26,000. Now, why do I have on there an arrow that says Roth? Well, what's interesting about the solo 401k is it comes with a Roth component. So you get two buckets with the solo 401k. You get a traditional bucket and you get a Roth bucket. You can put your employee contribution directly into that Roth bucket. That's an advantage of the solo 401k. All right. Now, the next component is the employer deferral. The employer deferral. So the employer deferral is up to 20%, up to 20% of your up to your self-employment income. All right, up to 20% of your self-employment income. Now, if you have like a S corporation and you're actually paying yourself a W-2 salary, then the factor that you use, or the number you use, is 25%. So either way, 20% or 25% of your total active earned income, not to exceed $58,000 when you're under 50 and $64,500 when 50 and over. So if you're paying yourself a healthy wage, you can get a considerable amount of money into this plan. But if you're only paying yourself a little bit of money, it might not make sense. Now, this employee contribution is up to 100% of your earned income. So if you're only making, let's say, $20,000, you can put the full 19.5 in, providing in this case you're under the age of 50. So let me give you an example. John is our investor here, and John, he's 50 years old, and John is making $150,000 in gross income. John is going to take $50,000 in expenses as a write-off. That income is going to flow through his Schedule C to his Schedule SE, self-employment, where John is going to pay Medicare and Social Security tax. So John's got $100,000 in self-employment income. All right, now he's in the game. He's got the price he paid the price to get in the game. John loves the Roth, so John puts $26,000 right into the Roth environment. That's after tax, just like a Roth IRA. Then we move over to the employer deferral, $100,000 times 20%. So the maximum is 20% of the self-employment income. 20% of 100,000 is $20,000. That has to go into the traditional bucket. Why does it have to go into the traditional bucket? Because the business gets a tax deduction for it. It's just like a 401k with a company you work for. From there, they're going to convert the funds over into the Roth via what's called an in-plan conversion. A lot of people are not aware of this in-plan conversion feature. Not all solo 401k plan documents support this. I am proud to say that EquityTrust, we offer both self-directed IRAs and self-directed solo 401ks. And we do full service work on the solo 401k. So we're the custodian, we're the third-party administrator. We provide you with the plan document, all the information and documentation and record keeping that you need to do. So we allow for this in-plan conversion. You convert the $20,000 over into the Roth bucket, and that leaves you with $46,000 tax-free. So I'm showing you, if you pay yourself $100,000, how you can get $46,000 tax-free in the Roth environment. So yes, this plan is powerful. And yes, you can be exempt from UBIT tax when you do leveraged real estate deals. But again, you got to make sure that you qualify. Lastly, you got to make sure that you don't have any W-2 employees working for your company that's sponsoring the solo 401k. And you can't just superficially set up a separate company that doesn't have any employees and open it up, because you're going to end up being in a control group. That's a whole nother topic of conversation. We can sit down with you and your CPA and really talk through this to make sure that the self-directed solo 401k is the right plan for you. All right, so I hope everybody enjoyed that solo 401k training component. Let me just breeze through this. You can loan money from your self-directed IRA. I mentioned that before. A couple deals just to kind of flash on the screen for everybody to get the wheels turning. I made a loan on this property right outside of Cleveland, Ohio, in a city called Parma. It was a $50,000 loan to a rehabber where I partnered my traditional and Roth together. So another highlight for everybody, if you're lending money secured by real estate already, or you want to get involved in lending money to other investors, you can partner multiple IRAs together. I partner my traditional and Roth all the time, making loans to rehabbers. That's exactly what I did on this transaction here. I made a 12% per annum interest loan, 6% for the first 6 months. It's essentially like a prepayment penalty. House was bought and sold in 5 months. I made $53,000. Well, rather, I should say $3,000 in profit and my $50,000 in principal. So at closing, the title company wrote a check for $53,000, made payable to my self-directed IRAs. I gave the check to Equity Trust. The check was deposited 50% into my Roth, 50% into my traditional. So I made a $3,000 profit. Now, interest income outside of an IRA is subject to ordinary income tax rates, which means that my tax basis, I would pay about $1,000 in taxes on that $3,000 in profit. But because I did it in my self-directed IRA, all of that profit is tax-free. So fast forward, rinse, repeat, reload, reinvest. 4 days after I received my money on that first deal, I redeploy my capital for another loan to the same rehabber on another fix and flip deal. This property I charged 14% interest on. My self-directed Roth and traditional partnered on the deal. My self-directed Roth and traditional had a promissory note and mortgage. That was the collateral, promissory note and first lien mortgage. I always make sure that I close properly and I record the mortgage to ensure that I'm in a first lien position. If that property unfortunately goes south, I can foreclose on the property or take the property back deed in lieu of foreclosure, and now my IRA owns a property. All right. Fortunately, that's not what happened here. The rehabber, so this investor of mine that I work with, rehabber, bought it and sold it in 4 months. My payoff was $54,000. So $4,000 in profit, $50,000 in principal. Deal number 3 in the same year, $55,000 loan, $27,500 for my traditional, $27,500 for my Roth. House was bought and sold in 3 months. My payoff was $4,400 in profit. My $55,000 in principal return split up 50-50. So if you're involved in lending money secured by real estate, know that you can do that as well with your self-directed IRA. All righty. So in conclusion, we talked about a lot this evening. I know that I went fast and gave a lot of content and information. Some major highlights: self-directed Roth, tax-free; self-directed traditional, tax-deferred; self-directed solo 401k. I showed you a quick demonstration of our My Equity digital processing portal. Know that as an organization, we've digitized most of our real estate transactions in record keeping and bookkeeping. So you can take advantage of our tools and resources so that you don't have to form an LLC or other type of entity and pay extra money to a third party, if you will, in order to accommodate those requests. You can do it all through your IRA. Showed you a joint venture real estate transaction. We talked about real estate options, wholesaling, private lending. So I know there's a few other things in there that I probably didn't summarize, but in recap, here's what we're going to do next. If you are interested in moving forward, if you know that you want to get started with a self-directed IRA and you want to work with Equity Trust, I can pair you up with one of our self-directed counselors. This is a one-on-one environment where you're going to talk to them over the phone and they're going to answer any questions you have. And if you're ready to set up and fund your account now, they'll help you with the paperwork over the phone. All right. We want to make that an easy process for you. You're of course going to have questions before. That's okay. They're here to answer questions and facilitate an environment where you can learn and grow in. We do not take a high pressure sort of financial services sales approach because we're a directed custodian, remember. So we can't give advice. We can't push you in one direction or another. We're here to inform, educate, and talk factually with you. So if you are interested in doing that, if you're interested in a one-on-one session, what you're going to want to do is email me at j.bowens@trustetc.com. And I'm going to pull up my chat box here in a second if I can. And I will try to post that email in the chat box for you to grab that. But otherwise, you can see it there, j.bowens@trustetc.com. And then if you want more training, if you want to come to another class of ours, you can come to our March 13th event. And this is at 9 a.m. Central. So this is Saturday, March 13th at 9 a.m. Central. I think Lloyd and John mentioned it at the very beginning. And so this will be a 2-hour class, Q&A. It's an event that we put together for clients as well as prospective investors. So everyone's welcome to come, where we go through a lot more case studies. I do a lot more whiteboarding. So some of the stuff that you saw today, we'll talk through if you need a refresher, and then we'll take some deeper dives in some of the content and material. So I will post this link as well in the GoToWebinar module for everybody. That way you have that up. So with that being said, let me just pause there. Lloyd and John, if there's any items that you want me to address specifically, feel free to speak up. I don't know if you want to allow people to put themselves off mute, but we can do that as well, or I can answer questions in the message chat box. So I'm just going to pause there for a moment and let anyone speak up that would like to.
Okay, I did see in the chat, okay, a couple of things. I saw, I don't know if you noticed, Jan Duke, she's one of our premier Ira self-directed investors. And
Yes.
she has some good comments. She said she heard your presentation 10 years ago and has changed their financial investing outlook considerably.
I appreciate that. And Jan, I didn't see your name there, but thank you so much for joining. It's always wonderful to have you on. I appreciate everything that you do. And yeah, Jan is absolutely I'll call her a power user of self-directed IRAs. I've been doing it for over 10 years and has just done so much with her and her family's self-directed IRAs. I've used a lot of their case studies in a lot of our training, and she's coming out and spoken at our events. So we of course, for those of you that have an opportunity to ever connect, what a great resource to have with us. John, I have had such a business like venture successful go through full, okay. All right. So IRA audits they're few and far between. I will say that. Can your IRA get audited? Yeah, that could happen. The key is that you're insulating yourself from prohibited transactions. And so we talked a little bit about the disqualified persons rules there. And you want to make sure you steer clear of transacting with disqualified persons. The other thing that I'll do here for everybody is I'll share my screen in a second as I talk through. But if you are looking for some additional info on, for example, disqualified persons and prohibited transactions, so the rules, if you will, we have a YouTube channel set up. So I've been creating YouTube videos for quite a while now. And what I've done is I've actually taken some of the most frequently asked questions and I have built YouTube videos. So smaller, call them 10 to 15 minute segments, and not an hour and a half type presentation like this. I've built these 10 to 15 minute segments, and there's you see here, joint ventures, partnering with multiple self-directed IRAs. So I talk about the rules in there. I outline disqualified persons. We actually have a video in here somewhere on the rules of real estate investing. So go to YouTube, click this little bell for notifications, subscribe to our YouTube channel. You'll get all of our new released videos. It's a great opportunity to continue to learn. I'm always updating these videos when new topics and new strategies are emerging in the marketplace. All right, let me go back to our questions here.
Yeah, there's one other one I saw earlier. I think it was Kathy was asking about sources for non-recourse loans. I know you mentioned borrowing money from another investor's IRA, self-directed IRA. But do you have also connections for institutions that do non-recourse loans that would qualify?
I do, and I'm sharing this on my screen right now. There is IRAlending.com. I'll go there. So there's a bank, actually, a matter of fact, out of Kansas City, Missouri, North American Savings Bank. They do non-recourse loans to IRAs. For those of you who aren't familiar with what is a non-recourse loan, a non-recourse loan is a loan that's compliant for an IRA. See, when your IRA borrows money under the provisions of 4975 of the Internal Revenue Code, it's actually 4975 C1B. If you're interested in any super light reading this evening, I recommend it. It clearly states that there's the lending of money in extension of credit. That's a prohibited transaction between the plan and a disqualified person. What that means, that's just verbatim, but what that means is you can't personally guarantee debt that your IRA is taking on. So if you went into a traditional lender and they made your IRA a loan and you signed a personal guarantee, you'd blow up your IRA. Your IRA would cease to exist January 1 of the year in which you did that. Prohibited transaction, full distribution, taxes, and penalties. Mortgage lenders know that they can't loan to IRAs, so they don't. So you have to go to one of these specialty lenders that understands non-recourse loans. North American Savings Bank is one of them. You can go to IRAlending.com for more information. I'll put that in the chat box as well for everybody. IRAlending.com. Another one is, this one might be a little bit harder for me to find, but another one is called First Western Federal. First Western Federal Savings. I'll just say IRA loan. That'll probably come up. Yep, here we go. MyIRAlender.com. MyIRAlender.com. So First Western Federal Savings is another lender that will loan to IRAs. Loan to value, you're not going to get an 80% LTV loan for an IRA deal. Why? Because it's more risk to the bank. There's no secondary market. They can't sell the paper. It's not a Fannie and Freddie type loan arrangement. This is a loan that's being originated by the bank, and that bank is going to service that loan through the entirety of the loan. So generally, the loan to value is going to be 65 to 75% tops is what I've seen. Usually these lenders have minimums of $50,000. And remember, if your IRA borrows money, then your IRA is going to have to handle the unrelated business income tax. So you're going to have to file what's called a 990T tax return and pay the applicable UBIT tax. In some instances, it makes sense for an IRA to borrow money and pay the UBIT tax. I have a client, Tim, in Texas, 2013, he did a fix and flip deal where he bought a property on owner financing. So his IRA took on debt. And his IRA took on debt at the tune of 91% leverage. Bought the property for 55, put 5 down, carried 50,000 in financing. So he was 91% leveraged. He made $38,000 in profit. He paid $14,000 in taxes, but he made $22,000 100% tax-free in his Roth IRA. Over a 50% cash on cash return on investment after accounting for the taxes paid. So in some instances, it actually makes sense to pay the UBIT tax. That said, like I mentioned before, if you qualify for a solo 401k, you do a leveraged real estate deal, providing that the loan is structured properly, you can effectively be exempt from that unrelated business income tax. All right, hopefully that little segment helped there for everybody. What else do we have? I'm just perusing the questions in chat box here to see if there's anything I missed or anything you'd like me to elaborate on. We got the link to the class, the mastery class, which is on March 13th. My email, I put my email in there, j.bowens@trustedtc.com. So if you're ready to connect with us, you want to talk more about how to open an account, fund an account, we can help you with that process. Just let me know. Happy to do that. Oh, David, thank you. David's another power self-directed IRA user. Appreciate it. He says, I wish I would have converted 10 years ago. So, I run into a lot of folks that, they they wish they should have converted, 10 years ago. Well, look at what your tax basis looks like now. Does it make sense for you to convert now? And we also have other training where we talk about converting in stages. So converting, maybe a little bit in year 1, more in year 2, more in year 3, so on and so forth, to then where you get up to a point where you have all your money in a Roth and you're able to effectively spread your tax burden out over multiple years. All right, Lloyd, did you have something you were going to say?
Yeah, I just want, you said you put the link to the March 13th. We do also have that link on our website, stlria.com, and our meetup site. We've got the links to register for that on our website and our meetup site both.
Yep. And I did, Lloyd, the link that I posted was actually the link right from your website.
Oh,
So
okay.
that's the registration link. When you click the registration link, you're actually going through the St. Louis Real Estate Investor Association. But,
okay, super.
Yep. But I got this up on the screen for everyone too, and the St. Louis website. And for those of you that are, I don't know if there's anybody that's not a St. Louis RIA member, but I will say, and thank you to the St. Louis RIA group. I've had an opportunity to come out and speak with this group and do seminars together for quite a few years now. And I visit RIAs all across the country. And, what a well-organized group, what a group that, really cares about their constituents and reaches out and helps, like people like David and Jan who teach and educate other people. So I've had nothing but just phenomenal experiences with the St. Louis Real Estate Investor Association group, and can't thank them enough for this opportunity and all the great relationships and friendships that I've built with group members over the years. So if you're not a part of the group, I definitely encourage you to check out the opportunity. I'm a member of my local Real Estate Investor Association here in Cleveland, Ohio. I want to say I maybe pay $250 or so a year. That entitles me to Home Depot benefits. That entitles me to some other benefits with some other vendors. And so it's a great opportunity for me to be able to take advantage of those benefits and also network with other group members.
No, appreciate that, John. Yeah, we do have a great group here, and our membership is only $75. So that just reinforces what a good buy we are for our investors, because we have no paid staff. Everybody that works for the RIA is part of it. We all pay our own membership fee and giving back to the organization because we've gotten so much out of it. And
outstanding.
Appreciate it. Appreciate you saying that.
Absolutely. Any other questions that I can answer for anybody? Yeah, Jan talked about the expense payments. So we do have the online virtual wallet where you can pay for all of your expenses. And once you get involved with your self-directed IRA and you buy a property, there's a process you go through, and we help you through that process. So when you're trying to manage, okay, how do I pay for these expenses? I'm going to Home Depot, I have contractors. How do I manage the logistics and mechanics? We can talk through those items right alongside of you. And of course, we talk about some of that in our additional training and education that we provide. So with self-directed IRAs, they're highly tax privileged accounts. So there's certainly a little different way that you would go about investing in real estate and owning and managing real estate. But you'll find that you'll start to develop those tactics and techniques along the way, as many of our other clients have throughout the years. All right. So John and Lloyd, I'll sort of hand things over to you. I think I've answered all the questions. If there is anything else that comes up, feel free to let me know. Otherwise, I'll stop sharing my screen and just kind of sit tight here and hang on until you want to close out the meeting or finalize any closing remarks. Thank you very much.
Yay, well, thank you, John. We really appreciate you taking your time this evening to share your knowledge. And you've really got a way of bringing it home with your examples of showing how it works with self-directed IRAs and 401ks. Yeah, I'm one of those that wish I would have started earlier. I'm in the process of doing some partial conversions every year for the next couple of years from my 401k. So eventually we'll get there.
Mhm.
So yeah, John, do you have anything else you want to share? I think I mentioned earlier, yeah, we have our, if you members here or visitors haven't tuned in on our 11 o'clock on Friday, when we have our legal update with Kathy Davis and her associates on the status of the court systems. If you have rental property and are interested in that, that's always helpful. And usually after that, we have time for haves and wants session. We can have, if you got something to sell or you're looking to buy something or want to offer your services to other investors, that's the time to do it. Tune in 11 o'clock on Fridays. And that there's a link to that. Register on our website and also on our meetup site. So other than that, we got our next major thing is Saturday on the 13th. I've already registered for it. I always got to test out the links when I put them on Meetup, so made sure it was working. So I got registered already for that March 13 event on Saturday morning. You have anything else, John? Really appreciate you pulling this together and making the contacts with Equity Trust to get John with us tonight.
Thank you, Lloyd. I want to thank John too for taking your time. I know it was kind of last minute. You had to do some rearranging. Really appreciate it. You're always so knowledgeable. I love listening to you, even though I think I know some of the stuff. You always have a great way of explaining and simplifying something that could be complicated for a lot of us. So thank you very much again. And thank you everybody for attending. Yeah, just watch your inbox. We have a lot of things planned. Some of the stuff we come up with last minute, some of it we try to plan ahead of time, but just watch your inbox, and you can always check the website, stlria.com. Again, thank you everybody for attending. Appreciate it.
Okay, thank you all. Till we see you next time. Take care. Stay safe.